All right, financial freedom can feel impossible when you are just getting started. Now, most people think becoming a millionaire requires stock picking, perfect timing, or just some kind of insider advantage. That's not the case. The truth of the matter is wealth is built quietly. And it's the same thing I say in all of my videos here. It's the quiet, boring stuff that builds wealth. Investing is how you turn a small amount of money into a very large one, just like planting a seed for a tree, right? The seed doesn't need luck. It just needs the stuff we always talk about here on Money Moves with Eric: time, consistency, and the right strategy. Welcome back to the channel. Today we are filming in the car and kind of changing it up a little bit, but we're going to get into exactly how index fund investing really works. At the end of this video, I'm going to show you a simulation of $1,000 step by step of that you can follow along and you can start today, and how I would do it. And without further ado, let's get into it. So what is an index fund? Can you answer that question? Do you honestly know? Have you done your research on it? If not, I'll give you the answer. An index fund is a pooled investment that gives you instant ownership in tons of companies with one purchase. One purchase. I'll say that again. So instead of betting on an individual stock, you're buying an entire market, right? Or basically a small portion of it. You're buying little slivers of all those companies. Index funds, they track something called a market index. And I'm sure you guys have heard of these. The most common indexes, what are they? S&P 500, the Dow Jones, and the NASDAQ. So those are the three that we all track. I love the S&P 500 and the NASDAQ. Those are my two favorites. But if you buy an S&P 500 index fund, you now own a slice of 500 of the largest companies in the United States. That's big. There's no guesswork with it. You're not stock picking. There's zero stress for it. Like, those are the best 500. You know they're going to win. You're betting on them. Now, index funds and like why they work. Well, here's a big advantage to that. If you haven't looked into this or you don't really know, with an index fund, your results, they're not dependent on like a highly paid fund manager getting lucky, because let's be real, most of them don't get lucky, and oftentimes you end up losing with them. It's better just to do things yourself. But you're investing in the entire economy, right? Especially like the S&P 500, the entire US economy. And over the long run, the economy grows, as it always does. So decades of research will show that the most professional investors fail to beat the market consistently. Yeah, they might get lucky a year or two or whatever, but they're not doing it every year. And that's why I like this quote from Jack Bogle, the founder of Vanguard. He says, "Don't look for the needle in the haystack, just buy the entire haystack," right? Like, that's the S&P 500 or the Dow Jones or the NASDAQ. That single idea is the foundation of index fund investing. And I really like that quote. I think it hits spot on. Next topic we'll talk about is expense ratios and the hidden cost form. So every fund charges an expense ratio, a small annual fee that's taken automatically from your investment, right? Now, some funds, they can charge different prices. That could be like 0.02%. Others might charge 1% or 2% or even more that I've seen. It all really just depends. That difference might seem really small, but over 20 or 30 years, it can cost you hundreds of thousands of dollars. Like, legitimately, like, it can make a huge impact. Fees are guaranteed. Returns are not guaranteed. So when you're choosing index funds, lower fees mean more of your money stays invested, right? That's why good index funds, they closely match their index performance minus a very tiny fee. Well, in that index fund and stuff, let's talk about like asset allocation. So asset allocation, that's going to be how your money is divided between stocks and bonds, right? Like, where is everything going percentage wise and stuff like that. A simple rule of thumb is use your age as the percentage in bonds. The rest goes into stocks. If you're trying to be a safe investor, basically, like if you're 30% bonds, 70% stocks, right? And then that changes as you get older. I personally don't do that because I like fast growth. Another option is Warren Buffett's approach. He says 90% stocks, 10% bonds. That's more along what I use. That's what I personally use because I like fast growth and tech and all that stuff. But again, whatever fits your personality. Inside your stock allocation, you can also split between like US stocks or international stocks. I like doing both. I'm invested globally, not just in the US economy. I have a small portion that is designated for international. And we'll talk about mutual funds versus ETFs, right? So index funds, they come in two forms. You're either going to have mutual funds, they trade once per day, or you're going to have your ETFs and they trade like stocks. So functionally, they're very similar, right? And what matters most is whether your brokerage allows automatic investing or not. And I'm not sure who you guys bank with or anything like that, but automation is how consistency happens, right? And consistency does what? It builds wealth, right? So let's talk about $1,000, how I would invest $1,000. And before investing, right, you need an account. So think of accounts like basically like your shopping cart, right? The best place to start for most people is a Roth IRA because of the tax advantages. The Roth IRA is my absolute favorite type of account. It's the one that I always preach. Once you deposit money, it's not invested yet. It's just cash, right? Like just sitting there. So to invest, you need to click the trade button. You need to enter the ticker symbol for what you're going to buy. You're going to choose the dollar amount and then boom, press and place the order. So using like a 90-10 strategy, like I was talking about that I like, $900 would go into a total market stock index fund. $100 would go into a bond index fund. And that would be my 90-10 split. That's it. It's that simple. It's repeatable and it's very, very effective over long periods of time. Let's talk about some millionaire math real quick and kind of what that all equates to. Here's where this will really click for you guys. Say you invested $500 per month into a simple index fund, but you did it for 30 years. You would have invested $180,000 total, but your portfolio could grow to over $1 million. Think about that. You invest 180, it could be over $1 million. Not because you're lucky, it's because compounding did the work over a 30-year stretch of time. Now, index fund investing, it's not exciting, right? Like I always talk about becoming wealthy is boring, and it really is, but it works, and it works very consistently. Start now, automate everything that you can possibly automate, improve it later, make your adjustments as you need. And every year you delay is a year your money is not working for you. It's just sitting in a bank account losing to inflation every year. Plant that seed today and just let time handle the rest. It doesn't matter if you're 20, 30, 40, 50, 60 years old. Start somewhere, start whenever you can, and just get it rolling. I'll see you guys in the next video.